Hi there, welcome to kneppyinvests. In today's video, I'm going to take a look at REA Group focusing on their financial year 22 results. The question I have here, is it time to buy back into REA Group? That's a question I am asking myself because at one point in time, this was my longest holding. I held REA Group from 2012 all the way through to the beginning of 2021. And I actually did a video on me selling out of this company and questioning whether that was a mistake. At that point in time, the valuation of REA Group was getting a little bit frothy. The growth in the company wasn't quite there to match the valuation. And I thought now's the time to take my profits. Fortunately, the share price has pulled back significantly since I did sell out. So I sold out about $160. Share price at one point in time dropped as low as $85. And I'm still kicking myself for not taking a new position in this company when the share price hit $85. Right now, the share price is around $120. And on the back of a really good financial year 22 results, and I was really impressed with how this company has performed over the year. And I do think there is significant growth moving forward for this company over the next 5 to 10 years. The PE ratio for REA Group right now is 40. And yesterday, I did a video on Woolworths Group. The PE ratio for Woolworths Group is 30. Yet this company, REA Group, is going to have significantly more growth than Woolworths Group. So if I had to choose between the two companies, definitely I will focus more on REA Group just because of the growth that is expected for this company over the next 5, 10, maybe even 20 years. This is the monthly chart for REA Group when I last did a video on the company in early 2021. And some of the reasons why I did sell out of my position in the company was because of the valuation and because of an acceleration in the share price from the depths of the COVID-19 financial panic. The share price of REA Group reached about $60 during that panic. And then we saw the share price increase from that $60 to $162 when I decided to sell out. The share price kept on rising after I did sell. So I did think possibly that was a mistake. But I kept reminding myself the reasons why I sold out because of the valuation and the lack of significant growth at that point in time in the company. However, the share price has pulled back enough, and we actually have seen some really good results from the company in financial year 22. So I think this is now a time to take a closer look at REA Group. Now on to financial year 22 results for REA Group, and these are really good results. I was quite impressed with how REA Group has performed over the past year. Now, in isolation, these numbers probably don't mean anything. So we'll look at the growth of this company in the next few slides, particularly focusing on revenue. So that is the first thing I always look at. And then I go to the cash flow statement and also have a look at the cash flow statement later in the video. The share price when I set up this video was $122.62, which gives a market cap of REA Group $16.2 billion. Now onto the revenue, $1.17 billion, significantly higher than last year. Profit significantly higher last year at $371.7 million. Operating cash flow significantly higher than last year, $487.6 million. And the earnings per share, $2.91. So if you compare the earnings per share to the share price, that gives a P/E ratio just over 40, which is not too high for a company that has returned to a significant growth model. And why I say return to a significant growth model will become apparent when we look at the revenue growth over the last few years. So let's have a look at the revenue history for REA Group over the past 10 years. Now, REA Group is a growing company. So even though I was a little bit disappointed in how this company had been growing from about 2018 to 2021, that does not mean this company has reached full maturity and there's no more growth left in this company. And that company has proven, or the REA Group has proven that to be right in financial year 22, where we have seen revenue grow at about 30% from the previous year. But if we go back all the way to 2013 and look at the last 10 years of growth in revenue for this company, we are seeing it growing at 10 or 15.5% per year. Over the last 5 years, 11.7%, and over the last 3 years, 10.2%. So it does look like growth in this company is slowing down. And the reason it does look like it's slowing down is because of what happened between 2018 and 2021. Specifically, between 2019 and 2021, it does look like revenue hit a little bit of a stagnant period there. But the good news for this company and good news for shareholders is the company has returned to a really good growth profile in financial year 22. And I have no reason to expect the growth of this company to slow down over the next 5 to 10 years. Now onto the cash flow statement for REA Group. So after I have a close look at the revenue for the company and just compare it to the previous year, I think then go straight to the cash flow statement and then work my way back to the balance sheet and the profit and loss statement. Also look at the note that is right next to the net cash inflow from operating activities for REA Group, that is note 8, because that gives us the reconciliation of profit to the operating cash flow. But anyway, receipts to customers increasing from 1 billion to 1.29 billion. So receipts up 29% from the previous year, and the operating cash flow increasing by 50% from last year, up from 321 to 488 million. So the next things I want to look at is any significant expenditures in investing activities or financing activities. And by far the biggest expenditure in financing activities was dividends paid to company shareholders, 194.2 million, but really nothing else here that is significant, and it is standing out. 87.4 million in payment for intangible assets, 87.6 million in the investment in associates, 413 million in proceeds from borrowings, but they also repaid borrowings to the tune of 422 million, so they sort of cancel each other out. But overall, they did grow their cash on hand by a significant amount. So they started this particular year with $169 million of cash, and increased it by $73.5 million. So they finished this particular year with $248 million of cash, which may not seem much when this company has a market of like $16 billion, but does give management a little bit more flexibility moving forward in terms of what they do with that extra cash, make some more acquisitions, spend more money in research and development, improving their products, that sort of thing, or maybe even increase their dividends for their shareholders over the next few years. And when I say increase their dividends, I'm talking about dividend payout ratio. More than likely, REA Group will definitely increase the dividends just because this is a growth company. Now on to note B, which is a reconciliation of profit to operating cash flow. And I do like, and I think I've mentioned this in every single video when I'm looking at financial year 22 results, I like the reconciliation found in the notes because this is very similar to the cash flow statements found for American companies, where they start with a profit and work their way backward. So we start with profit for REA Group of 371.7 million, and we just see why there's a difference between the profit, 372 million, to the operating cash flow, 488 million. And I'm really going to focus on depreciation, amortization, and also working capital changes, which is found down the bottom. And by far, the biggest reason why there's a difference between profit and operating cash flow is depreciation and amortization, $93.1 million for the year. There was also a negative 23.1 million for the net gain on acquisitions, disposals, and closures of subsidiaries, associates, and operations. But when we look at changes to working capital, nothing significant in there. For instance, there was a $13.1 million increase in trade receivables, but also a $13.3 million increase in trade payables, and they sort of cancel each other out. So no significant changes in working capital for this company over the past year. So this increase in cash flow in the past year, operating cash flow, is, even though it was 50%, is a significant increase in cash flow, and more proof that this company has performed significantly well over the past year. Now, REA Group is not only an Australian-based company selling houses, or they have a platform where real estate agents can sell houses on their platform. They have moved into India, and this Indian platform is called housing.com, and revenue in India has grown from 28 million to 54 million, so doubling revenue in the past year. Now, India, or their division in India, is not profitable just yet. In fact, a negative EBITDA to the tune of 35 million, but they are going to be spending more in India to further the growth of this company. And it does look like housing.com is gaining significant traction in India. So this is exciting for REA Group and exciting for shareholders just to follow how housing.com does perform over the next few years. And if they can further the traction that this company, or housing.com, has gaining in India, this is a potential absolute winner for REA Group over the next few years, the next decade, or even longer. Now, most companies do release some sort of financial year 23 guidance, or a current trading update or something like that in their financial year 22 results, and REA Group is no different. So they did give us a trading or current trading update to how the company is performing over the first few months of financial year 23. Nothing too significant in here. They did mention here the Australian residential property market is likely to continue to moderate. So that's more of an opinion than what's been happening as interest rates rises. July national residential new listings up 7% year on year. Sydney up 18%. Melbourne up 6%. They also mentioned that REA India, they expected to see financial year 23 EBITDA losses to widen as they increase their investment into REA India or housing.com. So no numbers or specific numbers here in relation to financial year 23 guidance. More than likely, we're going to see that either during the annual general meeting or later in the year or start of next year, we might see some guidance from REA Group. Now onto the valuation for REA Group and P/E ratio 43.5, which might seem high, but don't forget, operating cash flow of this company grew 50% year on year, and the profits and revenue grew significantly as well. So even though that does look high, this is a growth company. And if they continue to grow like we have seen in financial year 22, a P/E ratio of 43.5 might seem fairly low in 2 years' time. Price to sales ratio 13.8. Not too high when you look at the historical ranges this company sees for their price to sales ratio. And we'll look at the historical ranges of that ratio later in the video. And price to operating cash flow, 33.2. Not exceedingly high either for this company when you look at the history of their price to operating cash flow. So let's have a look at the history of price to operating cash flow for REA Group. And this is a way I like to determine whether a company might be overvalued or undervalued based off their past history. So unless there's a significant change in a business model, unless there's significant change in the sentiment for a company, and when I'm talking about significant change in sentiment, probably the best example of that is TPG about 5 years ago, when the P/E ratio of that company was in the 30s. And then David Teo at the annual general meeting said he doesn't expect TPG to grow that significantly in the next few years. And then we saw the share price absolutely tank because the expectations of the market had changed, because the expectations of the company had changed. And that was in the annual general meeting. So it's very important when these companies do their annual general meeting just to have a look at any sort of guidance, any sort of expectations management have for that company. But when we look at the REA Group price to operating cash flow right now at around about 33, it's not exceedingly too high compared to historical ranges. So I'm sort of counting out the last year and a half, because one of the reasons I did set out is when you look at the price to operating cash flow, price of sales, REA Group was getting a little bit frothy. We saw the price to operating cash flow get as high as 70 about 1 year ago. Now it's back down to 33. And if you look at the period between 2013 and 2020, the price to operating cash flow for REA Group was between about 28 and about 40. So right now we're right in between of that normal range we expect to see price to operating cash flow for this company. And to further hit home that point that REA Group is not overvalued right now based off its history, if we have a look at the price to sales ratio, we can see that spike in the price to sales ratio that corresponds with that spike in price to operating cash flow and corresponds with that time I thought the valuation of this company was getting a little bit too hot, a little bit too frothy. And we have seen a pullback in the price to sales ratio back down to between about 11 and 12 right now, looking at this from, I think this is from Guru Focus. This is from Guru Focus. Historically, the price to sales ratio for REA Group is between about 10 and 16. And 10 tends to be a really strong support level for this company. So just like the share price of a company, you do get support levels. So we have hit price to sales ratio of 10 about 5 times in the past 7 years, back in 2015, 2016, 2019, during the COVID-19 financial panic, and also in the past few months. We saw the price to sales ratio of REA Group reach 10, and we saw a bounce in the share price. And right now at about 13, or about 11 or 12 price to sales ratio, it's not too high in comparison to historical ranges we typically see for this company. And that's why I am now interested in taking a new position in this company, just because I don't think REA Group right now is overvalued. If I see a price to sales ratio of REA Group go down to say 8 or 7, that would actually mean, in my opinion, REA Group would be undervalued. Even though the PE ratio might be high, that sort of thing, I would think at that point in time, based off the growth profile of this company, that this company would be undervalued. And a way we could see REA Group's price to sales ratio, price to operating cash flow, and PE ratio get below its historical normal, historical mean, is if we see a major crash in the overall markets. That's a possibility moving forward, but it's not a certainty. And that's another reason why I am thinking about taking a new position in this company, just because the future is uncertain when it comes to overall market, the overall economy. Now onto the weekly chart for REA Group, and this goes all the way back to 2012. And to be honest with you, REA Group's share price is very well behaved. And the reason I say it's very well behaved is because it follows a trend. And that trend is that dashed line that is sloping upwards. And every single time, except once, when the share price of REA Group hits that trend line, we see a bounce in the share price. We saw it in 2015, 2016, closely in 2018. Again, a few months ago, in June of this year, we saw a significant bounce off the trend line. And the only time the share price didn't bounce off the trend line was during the COVID-19 financial panic. But it only stayed below the trend line for less than 2 weeks. And then we saw a significant bounce in the share price. So again, REA Group share price hit that trend line at $95. For some reason, I thought it was $85, but it was $95 in June. And then we saw the share price increase from $95 to $135. So the share price almost rose 50% in about 2 months. In the last few weeks, we have seen the share price of REA Group pull back to about $120. And if I see the share price move back towards the trend line, which would be about $100, I would become highly interested in REA Group at that point in time. That's all I have for this video, looking at REA Group and questioning, is it time to buy back in based off their financial year 22 results, and the valuation of this company right now is not too high. I wouldn't even say it's too low either. It's not undervalued. It's not overvalued. I think it's fairly valued right now. If I do see a significant pullback in the share price over the next few months, if we see a significant weakness in the overall markets, that might be the time to take a closer look at REA Group. If you have any questions about this company, if you have any thoughts, any reason why you might be thinking differently than I am, I'd love to hear your opinion. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.